you can see me as well?
Yes.
Yes.
Yes. Perfect. Sorry for turning on the meeting rather late, but I just switched from coming from the university to my home office right now because we are online. And I was at the university in the morning, so I just had to move because I don't know. Are you online the whole day today or the whole weekend?
Yes.
Yes.
Okay, so it's easier for you. Great. Still great having you here. As the last time, would appreciate to have some cameras on to get some visual feedback. As the last time, I would like to encourage you as well to join in, to discuss, to tell me your opinion, etc. Makes it more interesting for all of us, I think. We have now almost 2/3 of the audience inside, so 29, 30, 31 people. So I guess there will be still some more coming, but maybe they have to switch to the offices or whatever as well. So let's get it slowly started. As discussed the last Friday, I would like to continue now with trade finance because it's easier in an online setting. And we would finish then the project finance part next week. I think we meet next Friday afternoon in person at the university with one short group work as well. And I think the project finance part is easier if we do it in presence than online. So if you agree, I would start sharing a few slides. Sorry for looking away from you, but I have 3 screens here and need to adjust a little bit. We were talking when we started with the trade finance part when it was snowy, so we had different weather and different temperatures than today. We were talking about global aspects. We all have seen what happens around Iran at the moment, and then we were softly starting with the world of international trade and exports, and we were telling who the biggest exporters and importers in the world are, what the main figures look like, etc. And we stopped on slide 65 just before focusing on the Austrian market, and this is where I would like to start for today. So today we would start with what the situation looks like in Austria, and then move on a little bit to the more detailed topics. So I would like to start and hopefully finish with risk management today, and let's see whether we manage to get through terms of delivery as well. Let's see how things develop. So I'll try to share the correct screen now out of 3. Now you should see situation in Austria exports.
Yes.
And
Yes.
thank you. And sorry, as always, when I turn on sharing, I need to put you back on the right screen. So what does the situation in Austria looks like? Basically, we have already said that we know that Austria is a rather small economy. As small, let's say, developed and democratic the economies used to be, we are a rather open economy. Open means open to international trade, meaning import, exports, etc. Why? Because the smaller an economy is, the smaller the country is, the lesser the natural resources maybe are. We depend more on international trade because we simply cannot produce everything ourselves. And as we heard at the beginning of our lessons, there was the theory of competitive advantages, meaning it's better to focus on some things and to do these things well and to trade for the rest. And this is perfectly true for Austria. So as it says on this slide, we are exporting our goods and services to more than 200 countries in the world. You may ask yourself whether there are so many countries. The answer is depends on how you count. But it's more or less true. Not all of these 200 countries may be accepted as such everywhere in the world. More important, and that's why I would like to put a verbal exclamation mark. Verbal exclamation marks mean something for the test. Are our export ratios. And you see they're diminishing a little bit if we talk about export ratios of goods and services, but they are still above 50% and usually somewhere between 53, 55, 56% over the last years. We saw a peak a few years ago where they have been close to 60%. However, this changes as the landscape of the economy also changes. So if you have less exporting industry, for instance, these numbers go down a little bit. But still, it means no problem, Tobias, thanks. But still, this means that 5 to 6 out of 10 euros we earn in Austria come from exports of goods and services and from international trade. 50 or 60% of our wealth generated, if you would like to count GDP as wealth generated for the country, comes from export. And this is finally why you are in this class and why we deal with this topic, because for us as Austria, it's a pretty vital topic. If we wouldn't have any export, if we wouldn't have any international business, we wouldn't have this standard of living. Every second job, also if you count the number of jobs, is connected to export business in Austria directly and indirectly, so including sub-suppliers. Maybe interesting if we've been talking about roughly 200 countries in the world, situation also changing almost daily. But if we look at the top 10 exporters in the world, currently, 2025, we rank number 7. We used to be number 6 already, but you may remember from 2 weeks ago, we said number one exporter, number 1, 2, 3, United States, China, and Germany. Austria, being a very small country, a bit above 8 million inhabitants, ranks number 7 in the world. So we are really tiny giants if we talk about exports. And just to give you one number, please you don't need to remember the very exact number, but around 64,000 companies are doing export business in Austria, meaning they are selling their products and services abroad, which is still some number if we think of the situation in Austria. Please, in case of any questions, feel free to interrupt me as soon as you would like. So best thing is to yell immediately. You don't need to remember or to draw charts like this, but I wanted to show you the growth rate of exports. So the red line is really the number or the percentage of exports of goods exported, whereas the blue columns are sorry, wrong. The red line is the amount, the billion of euros of goods exported. The blue columns is the percentage, so our export quota, how many of the goods produced are being exported. So we see it used to be in the early 2000s below 50%. We then used to be for a few years quite above 50% roughly. We had the peak in 2022, 2021, reaching almost 60%. We are coming down to roughly 55, 50. But the situation is rather stable or still increasing. If we are talking about the numbers or the value in euros, then we see we still have growing exports, which of course you have factors like inflation, etc. inside. But still, we are on a growing path, and this is just here for illustration purposes. If you read certain statistics, yes, we have declining exports in the export quota, but still in value, it's still rising a little bit. Yes, we see signs of deindustrialization in Austria, but still We are not deindustrializing yet, but it's good to have an industrialization strategy. At least we have the paper now. We are still missing the action from the government, but to at least to have some strategy to say we want to have industry in Austria, we want to be an exporting country. We are aware of the problems that are around, like energy prices, etc., and we need to do something about it. Where do our exports go? 2/3 or 67%, these are the numbers for 2024, the latest ones I found published by WKO. 2/3 go to the European Union. Approximately 10%, 10% as the second biggest market go to North America, meaning United States, Canada, and Mexico. And this is why we are as Austrians also a little bit nervous if Mr. Trump introduces tariffs or other hurdles for exports. And the third biggest region for us is Asia. And in Asia, as we all know, mainly China. You still again see the growth rates, and where I would like to put also an exclamation mark is this top 10 trading partners of Austria. There's a bit more exclamation marks here in this section, but I mean, we are in Austria and we're talking about exports, so we should know what the situation is. So please remember, number one for us is, and historically always was, Germany. There is this saying used nowadays again, if Germany coughs, Austria gets fever. Also wenn Deutschland hustet, kriegt Österreich Fieber. This is true if you think that like half of our exports go to Germany. So we are really dependent on this market there. And if, for instance, the German auto industry has issues, then our industry, our suppliers, second, third tier, whatever, they feel it immediately. The second biggest market for us, and that's whether it makes us nervous still, is the United States. And the third one is Italy. This used to be different also in the last years. So we had a situation where Italy was number 2 already. A lot of efforts were put into increasing the business with the United States. Yeah. Now we have an issue with customs, tariffs, and whatever. And yeah, maybe interesting also the growth rates. You don't need to remember these. But maybe it shows some effort. We have an international growth rate of 174%, meaning we almost tripled exports within 25 years, which again, for a small country like Austria, is a tremendous effort if you think of it. Interestingly, we try to disconnect, or not maybe to disconnect from traditional markets, but to foster non-traditional markets. So we see a lot of effort in to increase exports with the Americas, meaning North and South America, with Asian markets, and also with countries like Australia, Oceania, etc. So Austrian companies supported by WKO by whatever means try to conquer new markets and to become a little bit more independent on what's going on in the world, so not being too dependent on one destination. But jumping back very quickly, I mean, if you have growth, if you have Americas with 11% in total and this tripled over 25 years, it's still good, but it's still not the majority of our exports, just to put things into perspective a little bit. Something you hear usually on the news is our trade balance, unsere Handelsbilanz. So always talking about positive or negative trade balance. If you look at a narrow basis, It's the chart on the right. We see we used to have a positive trade balance in 2023, most of the time in 2024, and now it's turning negative, which is a huge drama if you read the news. If you look at the left chart, then you will see that it used to be negative for most of the last 20 years. So our trade balance in goods, we need to say it's Handelsbilanz, so it's trade in goods is usually always slightly negative. So we import a little bit more than we export. It's always good to put things into perspective, because if you read the news today, you may have the impression that we are completely destroying our economy and losing ground completely. Of course, the path we are at is not the perfect one. We would like to have a different one, but still it's nothing unusual if you look to the chart on the left. So it's pretty normal situation for us. We have already also said, and please remember also this slide, that we have like 64,000 companies exporting. Another coin, not another side of the coin, but another coin of exports can be considered foreign direct investment. And foreign direct investment really in the sense of setting up a company abroad. So the one thing is trade, you're selling goods abroad. The other thing is direct investment. We should cover both here, and we will discuss both also when we talk about risk management, etc. Because setting up a subsidiary abroad still involves more effort, etc. But we have 7,600 subsidiaries of Austrian companies abroad. And to give you a job number, they created roughly 1.4 million jobs abroad. Of course, it's usually the neighboring countries, but Austrian companies, again, are very active in Asia, in North America. So you will find a lot of companies with subsidiaries there. On the other hand, we have almost 13,000 foreign-controlled companies in Austria. They have created a bit lesser jobs, but still around 690,000 jobs have been created by foreign companies in Austria. If you put this into perspective to roughly 4.5 million employed people we have, this still is some number, also triggered by foreign trade and foreign direct investment. So again, you see that this is important for us. Yeah. Again, foreign direct investments, Germany, Austria, and the Netherlands are top 3 countries for Austrian foreign direct investments abroad. Does anyone have a guess why Netherlands? Everyone fallen asleep already.
No, but actually no idea.
No idea? Okay. An educated guess? Somebody?
Maybe
Why
because
could
of the
Netherlands?
taxes.
Yes. I mean, I don't know, and you don't find the publication, but this would make really sense from my point of view, because Netherlands have a very favorable taxing system, and there are things like special constructions how you can monetize on tax avoidance, let's say it like this. So there are things like, what is it called, a double Dutch sandwich, where you involve Dutch holding companies and pricing strategies to avoid taxes on the home market. So if you would like to Google it, I'm pretty sure it's due to taxes. Maybe interesting for you, where is Austria? Where are Austrian companies investing heavily apart from these big 3? It's the neighboring countries and the former countries of, let's say, what used to be Austrian monarchy, and the former countries of what used to be Eastern European communist countries. So Austria is number 1 investor in Slovenia, Croatia, and North Macedonia, meaning we are really the biggest foreign investors there, even before China, Germany, etc. And we are number 2 in Slovakia and Bulgaria. So Yes, sometimes it's triggered. It's been triggered by huge investments. So Slovakia was when Erste Bank bought Slovenská Spořitelna, the biggest bank there. It was a huge investment, which of course put us higher in the rank. But again, traditionally, we have some access to this market. We have, in a lot of cases, a similar culture. We know the culture for 200 years. We have been in the same country with a lot of these countries for quite some time. I always say, if you look of the into the land book, into the register of land in Austria, in the Czech Republic, in Slovakia, it looks pretty the same. Because the idea goes back to Maria Theresia, and therefore it still has the same look and feel. So even history does something with economics. Yeah, this is just a small press release for 2025 to show you what happens in a single year. So in 2025, we managed to acquire 900 million euro in foreign direct investments, which created roughly 2,800 jobs, and 2,000 new companies, at least on paper, have been found in Austria. By the way, Austrian Business Agency, ABBA, has nothing to do with the Swedish band, but is like an outsourced company of the Ministry of Economy. So they are the ones who try to acquire foreign direct investments to Austria. You don't need to remember this, but just for illustration, what happens within 1 year. Still 2,800 new jobs is still something. Any questions before we move on to Austria, to the situation in Austria?
No.
No. So I think it was just a roundup for the last part we had, coming from the big picture, from the international trade to what does it mean for Austria. And now we are starting to take a deeper dive into the topics. And for the deep dive, I would like to start with trade risks and risk assessment. How do we assess these risks in international trade? And you will see later on all the things we come across until the end of this semester will be more or less about risk management, not because it is a risk management class, but you will see that whether we talk about payment options and payment alternatives, different tools and techniques we can use, whether we talk about insurance, etc., is always this idea of hedging risks, covering risk, etc. behind it, because simply risks is what makes international trade a little bit tricky. And risk management has nothing to do with fear. It's the complete opposite. It's managing, in the sense of proactive and being on the driver's seat and being aware of what could happen and not making any mistakes. So how I would like to approach this is, you may have realized I always try to start with something like a small definition or a small wrap up. So I would like to go through how can we identify, assess risk, how can we classify them, how can we employ a risk management strategy or a basic policy at least, and how can we hedge risk, how can we deal with them, how can we get rid of them ideally, so that we can do our business and focus on making money in the end. I always used to differentiate a little bit between the terms risks and hazard, because they are sometimes mixed up, or the German equivalent would be Risiko und Gefahr. And you know that we use them somehow in the same manner. But if you think about it, a hazard, thinking of natural hazard, for instance, is a potential source of harm. Okay, natural, anthropogenic, technological, whatever combination. But there's a difference to risk. For those, may I ask whether anyone where would you see the difference to the technical term risk? Or did you scroll forward in the presentation already. Also, let's jump on.
Risk is something what can happen, but don't have.
Yes. So now it's, I would say, or what I would like to reach is that a risk is something we try to measure. Let's say a hazard is sometimes perceived like an act of God, and yeah, we need to live with it, and we don't know whether it happens or not. Risks you usually try to measure with some probabilities, etc. And of course, you can calculate the probability of being hit by a lightning. But when a lightning strikes you, I mean, it doesn't help you that the probability is much lower than winning the lottery. If we could choose, I would rather win 2 times the lottery than being struck by a lightning for 1 time.
But is it
Yes.
that the probability of a hazard doesn't matter to your business, so it has no serious effect?
Nah, I think it matters a lot, but I think it's harder to assess. Just to give you a basic example, I think it's 1.5 years ago, almost 2 years ago, where we had the huge floods in Styria and then Lower Austria, where a lot of houses were flooded. Of course, a lot of businesses were flooded due to heavy rain, etc. So it's hard to calculate this probability. And of course, it's also hard to insure, but because if you have your own house, you know that all these natural hazard insurances cover only very little. So you cannot really insure against your house being flooded completely. Or you can insure, but you will get some 50,000 euros.
But you can prepare your house for a nature catastrophe, like building sand walls or something like that.
Yes. If you know it on time,
No,
of course.
no, I think there is something like a cellar where the material, also so ein gewisser Beton, der was wasserundurchlässig ist, etc., etc. Ja. Sowas meine ich, ja.
And I see. I mean, you are right. If the water if it's groundwater, I mean, I have such a cellar, and I hope it will always last. It worked for the last 18 years, because I'm at Steinfeld, and you're basically sitting on a lake of groundwater. The other thing is if the water comes from above and it comes through the windows and through the canal, etc. And usually it's hard to prepare for that. But insurance-wise, it's almost the same thing. So you get under these catastrophe schemes, you get very little money from insurance companies. Yes, Arlind, you wanted to add something, or?
Yeah, just a side info, a colleague of mine told me, because he was impacted, the insurance company told him that if he would have flooded his cellar by his own, they would have covered everything.
Okay. I know
Versicherungsbetrug.
one company,
Yeah.
honestly, that does it. Now there's a restaurant in what is this, at the Danube River, close to Hamburg. I don't remember the village now, but they're very close to the Danube River, and they have this issue every time when it's raining a lot that the Danube may flood the whole restaurant. And what they do is they flood the whole restaurant themselves before the high water is coming, just to keep all the dirt outside. Because if you flood your restaurant inside completely, then you have clean water inside, and you don't need to do all the cleaning and renovation afterwards. You just simply need to dry it. Really, they do it like 2 times a year. And the insurance pays for that. So they know they have to remove all the refrigerators, etc., and they remove the furniture if they are warned early enough. But yeah, but you never know, and you cannot calculate, does high water come once in 100 years or 1 in 10 years or 5 times per year. There are, by the way, in case you consider buying a house, There is something in Austria called a Hochwasserkataster. I don't know whether you've heard about it.
Yes,
So
that's very nice.
yes, so you can look up the probability of being flooded. I mean, I did it before buying my house, and it said even in 1,000 years I shouldn't be flooded because all the rivers are too far away, and I'm a little bit elevated. But what no one knows is what climate change does. And what we see now is that the once in 100-year events appear every like 30 years now, and that's nobody was prepared for. But this is very different, very difficult to measure. That's the issue. And therefore, if you're talking about risk, we try somehow to identify, to concretize this rather abstract hazard term, and you try to make it somehow measurable. And this making it somehow measurable is the attempt to calculate your risks and to reflect it in your prices, because if you don't know about any probabilities, etc., then it's hard to calculate the price in the end. So talking about this high water catastrophe, if I would calculate that I'm being flooded every 100 years, then I say, okay, it's not my issue anymore, but it's maybe the issue of my grandchildren, should the house still be here. If I have to calculate that I'm flooded every 20 years or every 10 years or every year, then I need to add some risk premium into my calculation. And of course, being flooded is a very extreme risk, but there are risks that occur on a daily basis, more or less. So if you run a taxi company and you have 20 taxi cars, the probability that one or two are being involved in a car accident like every month is rather high, and you will have to calculate these risks. Sorry, it has nothing to do with international trade now, but just to give you a very simple example of what I mean. And if you try to calculate, if you try to somehow form a risk policy, you try to assess the impact, the economic impact on your business in terms of liquidity, rentability, and creditworthiness. You all know what these terms mean? Yes, I guess. So liquidity means liquid money you have in the company, or rentability does something to your return on investment, and creditworthiness, if everything is lost, then you are not creditworthy anymore. Yeah, and therefore it's necessary to assess, to evaluate, to formulate a risk policy, and to employ some kind of risk control in the end. Have you heard about Peter Drucker, this management guru coming, I think, originally from the marketing side? Is it familiar to anyone?
No.
Oh, it's used to be a native Austrian, immigrated to the United States, kind of management guru. Isn't alive anymore, but is being cited a lot of times. Has written, I don't know how many books. As a citation, a quote from him saying, if you can't manage it. And if you think of this sounds very simple, but it's true for a lot of cases. So if you can't measure your risks, you can't manage your risks. If you don't do sales forecasts, you can't manage your sales department, etc. So it's a very simple saying, but it's there's a lot of truth in it. So yeah, a lot of truth in there. So how does basic risk management look like? I think rather simple at first sight. Risk identification. I mean, I hope nobody doing business out there is blind and doesn't deal with risks and doesn't think of risks. So I think risk identification almost every entrepreneur out there is aware that there are some risks that could happen to his business or her business. And the question you should ask yourself is, what risks may arise in the course of my business? The second thing, and this manages like 80% of the companies, they try to analyze the risks. So the probability of occurrence, the expected impact, what does it mean for my liquidity, for my credit worthiness, for my business relations, etc. Still, I think most of the companies manage to do this. And you see the quota is shrinking. I would say out of this 80%, again, 80%, so you end up with some 65% maybe, employ a risk policy. Not meaning, oh, we are aware of a risk and maybe we need to insure against something but they really try to employ a risk policy, meaning they systematically evaluate their risks. They think how they can manage the risks, whether they can, let's say, outsource the risk to somebody else or move the risk to their business partner or outsource it to an insurance company, whatever, how to manage their risk, but they try to employ some kind of a policy, which is really, really, really well, very well, if you think of this like that as an entrepreneur. Unfortunately, most companies, to my experience, and I've seen quite some, especially when I was working for the bank, forget about the last point, and it's risk control. Really, again, in the sense of checkup, controlling, being in the driver's seat, managing. So you should not end with employing a risk policy. Why? Because risks may change over time. And then you always have to recheck, have my assumptions been correct? Does this happen? Do I need to adjust anything? Do I need to change my insurance company? Whatever. So this should always be a feedback loop, and it should lead you to the very beginning and again to reanalyzing the risks I have. Sometimes also, aren't there any risks anymore? And can I save on the insurance if I don't need it anymore? Yeah. So it can be in both directions, but unfortunately, this last point is usually missed out. So what happens in practice? Very simple example. Somebody starts a plumbing company. Is a very little company, maybe one person alone. The company grows over 10 years. They have some kind of accident. They need to pay something, and they find out that they haven't adjusted their insurance policy for 10 years. And he used to have 1 million turnover and one person working, and now he has 50 million turnover and 30 persons working for him, and he's still insured for 1 million. And then the insurance company tells you, I'm sorry, you are underinsured. I pay only very little because you saved on the premium, basically. And this shouldn't happen. Therefore, risk control is a crucial thing that should be done. I think so far it's easily digestible, isn't it? Yes. Yes. Silence means yes. What are basic risk policy strategies? If you think how can we deal with risks, if talking about risk policy, the first one is risk avoidance, means try to prevent the occurrence of damage from the outset, try to avoid any risks. A typical example could be try to avoid the risk of non-payment by demanding cash on delivery or cash in advance. It's always a good idea if you are selling something, ask for the money before or hand it over against the money, then you are sure that you are being paid. Of course, we all know in the course of business, it depends on how powerful you are in negotiations and how exclusive your product is. So if you are in a mass market for, I don't know, paper napkins, it may be hard to negotiate cash in advance payment in your contracts. But avoiding risks can be a simple strategy. Risk reduction, something very close to it, meaning you're trying to reduce the risks as far as you can. An example here would be minimizing currency risks by diversification of exports to different countries. Depend if you say, okay, if you have the feeling the US dollar gets weaker and the Japanese yen gets higher, then you can diversify like this. Another strategy would be I try to get my payment in euros all the time. The third strategy could be I do a natural hedge. If I'm selling in US dollar, I would try to buy other goods in US dollar as well. So I don't run these currency exchange rate risks all the time. Third strategy, basic strategy, is shifting risks either to your other contractual party. So this is usually a very popular game between the buyer and the seller, between two parties to any contract, trying to shift the risk from one side to another. Again, it depends on your bargaining power in the end, how successful you will be. Thinking of the automotive industry, if you are a supplier there, usually you have very little bargaining power, and that's why usually the suppliers bear most of these risks in that industry, because you can be exchanged rather easily. And you are maybe dependent on one or two single clients, so you don't have the possibility to move somewhere else. Yeah, you could also shift to an insurance company. Of course, you can insure against certain risks, so this may make life easier as well. Yeah, and the last thing you could do is simply bear the risk. Risk bearing is also a strategy. You leave the risk in your company, you do not insure against the risk, you calculate with the risk. This is important. So risk bearing is an educated decision you make. You know about the risks, you have evaluated them. You do not insure against them, you don't shift them anywhere. You simply calculate with them, and you usually do the calculation by adding a risk premium to the sales price of your product, if you are able to achieve this price in the end. I had a long time ago a professor teaching insurance and risk management at the university, and he said, I calculate or I insure myself only against risks that do a significant harm to me, that would kill me or hit me financially very, very extremely. And I never insure small risks because it doesn't pay off. Only the insurance companies monetize on that. So my typical question now would be, does any one of you has a cell phone insurance for their smartphones?
Nope.
No, nobody?
Yes. No.
So you have one? So either you have a very expensive smartphone, or you are calculating the probability of something happening a bit higher than the median here of the colleagues. So these would be products where I would think twice whether the insurance pays off. Although I know some providers have it included in their monthly fees, so it's not much of an issue. But typical example, for instance, for myself, I have a full insurance for my car because it's rather new. So in case I would ruin my car, it would really hurt. But I have very high deductibles. I think it's 600 or 700 euros per case, because a small dent or whatever wouldn't ruin me, and the car is still running, and you can save on the premium then. Is risk management a specific of foreign trade? Of course not. You should always do it like every day and in every course of your business, and even in your private life. It's always good to think about risk management, but still international trade increases some risks or brings new risks to your business. Risks may be a bit bigger or at least different and may therefore require your attention. Think of a bigger geographical distance, which does something to transport risks, to communication possibilities, etc. The longer the distance is, the more may happen on a transport. It simply makes a difference whether you sell your goods to Mombasa or to Mattersburg, because the physical distance is bigger. You have differences in mentality. In marketing, you would talk about the so-called cultural distance. We will come to that part, but there may be a lot of misunderstandings due to different cultures, etc. You have language barriers even within the same language. I think everyone knows the specifics of Indian English. The pronunciation sounds a bit more interesting, etc. So you may have language barriers there. The political framework is different. The legal framework is different. I mean, try to sue somebody in China for copyright infringements. It may be theoretically possible, but I don't know whether you and your company would survive the court proceedings because they may take like forever. But you don't need to go to China. The same thing is true within the European Union. You have different currencies specific to foreign trade because it involves currency risks and many, many more. Yeah, and you can then try to classify risks somehow. They are very, very different approaches if you look at the literature of foreign trade. Usually you try to differentiate a little bit between market risks. So it's basically macroeconomic risks, political risks, etc. And between the risks of your counterparty, so of the debtor, if you sell something, or of the seller, if you buy something. Usually it has to do something with his or her credit worthiness. And yeah, maybe put a small exclamation mark here, but this is a very common classification found in many textbooks, where you say commercial risks as market risks in a stricter sense, transportation risks, and contract fulfillment risks. Then you have this huge area of political risks, meaning things like war, strike, etc. Payment risks or conversion and transfer risks always refers to a currency. So conversion risks meaning, can you exchange the currency to another currency? And transfer risk is, can I get the money out of the country? Good example would be Russia, where there are still some companies, Austrian companies in Russia. They still have money there, but due to sanctions, etc., it's impossible to recover this money. So yeah, they need to wait whether the war will end and when, and then maybe they will be able to recover money. And then you have currency risks in the transaction, meaning in the transfer of money. Economic risks like devaluation of a currency. We will look at this in a bit more detail. And translation risk is basically something that you come across in accounting. The best example I can think of is how you evaluate your receivables, for instance. So everyone who is in accounting or close to accounting knows when you're doing a balance at the end of the year and you need to prepare your balance sheets, then there's always the question of how you evaluate receivables in foreign currencies and which exchange rate do you take. So this is usually translation risk. But if you are a huge international corporation and you have subsidiaries in several parts of the world, this may do something to your balance sheet only based on valuation things. At the end of the year, the balance sheet may look completely different. Are you ready to take a deeper dive? Or
Surely.
board completely?
Ready.
Yes.
Yes, of course.
Yes. So let's go for it. So let's start with commercial risks and with the market risks in a bit of a stricter sense. How do these risks happen? Mostly it's simply a business misjudgment. You have overestimated the market, you have underestimated the market. You think you're going to sell 1 million items, you find yourself with selling 150,000 items, etc. So usually, most of the time, it's a misjudgment, a bad analysis, or it's events beyond your control that simply markets change. I had a colleague, he was thinking of buying an apartment in Dubai 3 months ago. I don't know how his judgment is nowadays, but markets change. Whatever the reason is, it may mean loss of capital and a threat for your potential profit. So if only the profit is gone, it's the less worse thing. If you really lose capital invested, etc., then it hurts much more. And yeah, incorrect assessment of the market could be possible overestimation of sales volumes, pricing, substitution by other products. What is the market for cars in Vietnam? Any one of you been to Vietnam, for instance? No? So they have an upcoming auto industry, and the market potential for cars is growing. But if you go to Vietnam, you will find out that like 90% of the population use mopeds and mofas for their transportation, so small motorcycle. And they are basically moving on 2 wheels, but not in cars. So you could say, oh, it's a huge potential. It's a huge market with a huge potential to say cars. Or you may think, okay, it's because these small motorcycles are cheap and they need very little fuel, and that's why the people ride them. Yeah, price erosion. If you miscalculated on the prices, you have unsuitable products. There are so many famous examples in the literature. Mattel was trying to sell blonde Barbies in Arabian countries. Nobody wanted a blonde Barbie doll there. But it happens to huge companies all the time. So if you would look for unsuitable products, you find a lot of things. You selected the wrong market, you selected the wrong channel for distribution, wrong timing for market entry, whatever. Basically, whatever you can think of in an economic sense can happen. The only thing you can really do about it is do an appropriate market and company analysis, make studies, buy studies, go there, try to observe, adjust your communication policy tailored to the market. Adjusting communication policy can mean taking care of religious feelings, etc. people may have in certain markets. Try to adjust your product. That's why dark-haired Barbies came up 30 years ago, because they found out they are limited with selling blonde Barbie dolls in some parts of the world. So nowadays you see dolls with darker skin and darker hair. So also children in other countries can play with Barbie. But they have learned from these things. What other risks you may have? Del credere risk. Del credere, Latin, it's a banking term, more or less, means it's the risk of unpayment or the credit worthiness risk. Basically, it's the buyer's unwillingness or inability to pay, or his complete default. So complete default means if he goes bankrupt, then he's in default. If he's unable to pay, he has very little money, then you're having the del credere risk. In a lot of cases, he's simply unwilling to pay you also the same type of risk. How could you hedge this? Again, please, all these hedging options you see here, it's never taxative, so it's just examples. You could think of 20 different options. The easiest way is, and the most cost-efficient way, if you manage to do it, is adjust the terms of payment in your contract. So we will see during the course of our class that a lot of things can be done by smart contracts. Yes, Julius?
Maybe something like Bernale too.
Vale?
Bernale.
Yes, did I get yes? So you could ask either for this, like kind of institutionalized damages, then institutionalisierter Schadenersatz. Yes, this would be one option. The much simpler option is the one we discussed before, payment in advance or payment at delivery. I mean, payment at delivery can have some risks included, but cash in advance as a payment term, if we manage to negotiate this, then we are pretty on the safe side. Then, of course, the other party bears all the risks. But everything between cash in advance and payment on open invoice, also offene Rechnung, everything in between reduces the risk. Let's put it like that. We could use some kind of collateral, like a bill of exchange, a bank guarantee, etc. We will talk about all these things at later dates. Letter of credit would be an option. Accreditiv, maybe somebody heard about this already. There are credit insurance schemes where you can insure against the default of your business partners. We could sell off the receivables. Maybe somebody has heard of things like factoring already. So you see, you have plenty of options you could think about to reduce the risk of non-payment, basically. If from a seller's perspective, we are facing the risk of unpayment, of course, always think that the buyer is facing the risk of non-delivery. And that's why he will not be willing to accept cash in advance, maybe because he says, okay, and I'm running the full risk, I'm not getting my goods then. And that's why usually you try to negotiate something in the middle. Another thing is the risk of acceptance or delivery risk. If we deliver something as exporters to somebody abroad, and the buyer doesn't accept the goods or he doesn't accept them on time or whatever, then we are usually running into problems. Why? Because if we are exporting goods to India, and I don't know what we could export there, doesn't matter. We export something to India. We have delivered our goods. They are in India already. Our buyer tells us, I don't accept them. I don't want them anymore. I've bought somewhere else cheaper. Then we are running into a problem because we either need to transport everything back. We are losing transport costs. We are losing time. Maybe the goods may perish. Or we need to sell them to somebody else on the Indian market, which we may succeed, but usually only at a discount. So we may have a loss in profit or whatever, because we simply need to get rid of the goods. And non-acceptance on time is usually a tricky issue if we are talking about perishable goods. So think of everything that is connected with food, etc., agricultural products, then this non-acceptance or too late acceptance may be a problem. And as we said, delivery risk, if the buyer pays us in advance and we don't deliver, he's facing the risk that he doesn't receive the goods from us. He does not receive anything, or he receives them too late, or in the wrong quality, in the wrong quantity, whatever may happen. So again, what could you do about it? You can buy credit reports or ratings on your counterparties. So you may try to ensure that your counterparty is a well-rated company, that there's good experience with them. Something we do in our private life, if we look at Google and say, I'm going only to a restaurant which has at least 4 stars. Smart contract design, again, try to negotiate the contract as it suits you best, because it's always the cheapest option. But you can use all kinds of payment methods we will be talking about, like a letter of credit, for instance, to reduce this type of risk. Sorry, with all these payment methods, etc., I need to ask you for a little bit of patience, because we will come across these things in more detail. Yeah. And then we have location risk. This is specific for foreign direct investments, meaning setting up a company abroad. If you look at setting up a company, any idea what you should look at? I mean, it's here, so you should first thing is there a qualified workforce? Will there be somebody producing my product? How is the wage structure? How is the infrastructure? Yes, Julius?
I think something is missing. Education is very important
Yes.
too.
Of course. I mean, I think it's with qualification of the workforce, we could say. But you are right, of course. Yeah, legal and tax environment. Are you in kind of a stable economy, a stable country? Do you know what was it? Costa Rica, I think. The Banana Republic. Do you know where this term comes from? You know what a Banana Republic is?
Yeah, it's not a highly educated and industrial country, something like that.
Yeah, and usually the connection is with being very corrupt, etc. But the term has been I'm not sure whether it was Costa Rica or Honduras, one of these two. But they share the same face basically. Because United Fruits was the biggest investor in these countries, and they've more or less colonialized these countries. And United Fruits is famous for Chiquita Bananas, American company. And they said there the term Banana Republic comes from, because they said basically United Fruits ran the country for 100 years. And the issue is, if you now think of, I don't know, setting up a steel mill in Honduras, just to give you an example, I don't know whether it's a good idea, because you would need to think, do they have steel workers? Do they know how to produce steel? Do they have iron ore? Where could I get the iron ore from, etc.? So these would be the things, talking about location risks, you would need to think of. Or an unfamous example, does any one of you know the movies Back to the Future? 1, 2, 3?
Yes.
Yes, Michael J. Fox. And the car they had, the DeLorean, the silver car they used for the time machine, it should be the first ethic car. It was designed by John DeLorean, who set up a company, and he set it up in Ireland because Ireland had no industry at all, and they paid him a lot of subsidies. But the issue was, as they had no industry and no tradition in building cars, they had no skilled workforce. They had nobody to put the cars together, so the cars were completely crap at the very beginning, and it ruined the complete company because they had to do so many repairs on guarantee, etc. So this is one very unfamous example if you decide your location only on one factor, in this case being subsidies. But it can be a famous example because this is one that happens quite often. So when I was doing corporate business at the bank, I had a lot of clients. They said, I'm moving to the Czech Republic. I'm moving with my production to Slovakia. They said, yeah, and why? yeah, I'm getting a subsidy. And then I asked, and who's going to buy your product? Yeah, I don't know, but I'm getting a subsidy. And where do you get the workers from? I don't know, but I'm getting a subsidy. So it was always like this kind of discussion. And I always said, it's great if you get a subsidy, but think of who is producing, who is buying, where do you get the material from, etc. And if you then get a subsidy, you're a lucky one, and take it, but it shouldn't be the sole decision factor for you. But it happens to me like 10 times a year because a subsidy is something very attractive. And a lot of companies decide to invest based on subsidies. So Elon Musk built his factory in Brandenburg because he got a lot of subsidies from there. Yeah, transportation risks is a very typical example, not only in international trade, but why much more important in international trade, simply because the physical distances are so much higher. And transportation risks always refers to the possibility of damage or a partial or a complete loss of goods. And you could subdivide it into local transportation risks, meaning you simply deliver to the wrong place. Sounds weird, happens all the time. Thank you, Raul Antonio. Welcome.
Thank you.
What happens? No, sorry, Raul Antonio just wrote that he has just joined in. Oh, thanks for the information. Then you have temporal transportation risks, meaning a delayed delivery. It happens in international trade all the time. Think of now Strait of Hormuz. We have talked 2 or 3 weeks ago about Yemen bombing ships around the Suez Canal. So the ships need to take a detour, and if you need to go 6,000-7,000 kilometers longer distance, you have a delay, and we will see disruptions in supply chains again now, as we did, maybe not that huge, but similar to what we had with COVID, I guess. You have the quantitative transportation risk, so loss of goods, part of goods, all of the goods. And you may have qualitative transportation risk. Again, if you think of perishable goods, they may spoil, etc. So if you're not deliver on time, you may have problems. Maybe one practical example, I once had a client, he had to deliver, I think it was 8 or 9 train lorries, so Eisenbahnwaggons of goods. And all the goods were stolen, and the lorries were stolen in Romania at that time. And they were never discovered again, so this would be a quantitative transportation risk. But these things really happens. Last year in the same class, I had a colleague working for a freight forwarder, and he told that they have stolen 2 trucks with goods, and they found 1 truck, I think, in the Netherlands without goods, and they have never found a second truck. So these things happen rather frequently, unfortunately. What can you do about it? You could do a transport insurance if something happens. You can use the delivery clauses. We will talk about them. So meaning using a certain delivery clause, you pass on this risk to the other party of the contract. So if we are exporters, we try to pass it on to the buyer. Yes, and there are some specialties. We will be maybe talking about it a little bit. If you think of maritime transport, maritime law is something very interesting, but rather complicated because it's a bit different from what usually happens when we are transporting things on roads and by rail, etc. I think most of you know this picture. I have it seen on the news, or most of you know the Ever Given, I
Yes.
think.
Yes.
Yes. So this was this huge ship stuck in Suez Canal. Yeah, and this is taken from above, so you really see it blocks the canal completely. It was in March 2021. This is what it looked from the perspective of another ship. So I guess these have been on the news. You probably know it, but it's a perfect transportation risk example. And maybe you don't know this one, but it's just to give you an idea of how big the ship is. The other thing is the Empire State Building in New York, if you would lay it to the ground, which some 80, 90 years ago used to be the highest building in the world. So you see the ship has the size of the Empire State Building, even with the antenna. So it's really a huge thing, and that's why it took them so long to get it out there. And if you see on the left side, it's traffic before the Suez Canal, so in the Gulf of Suez, 2 days before the ship gets stuck. And if you look at the right side, it's the traffic jams 2 days after the ship got stuck. So you see what happens to supply chains if you have one ship stuck in the Suez Canal, and the ship is like in the upper right part here. So these are satellite pictures from the European Space Agency. But you get an idea of how many ships cross the Suez Canal. Maybe lesser now if Yemen is again throwing bombs, but yeah, these are real distortions to international trade. And you're running a physical transportation risks if your goods are only ever given because a container may fall down or whatever. And you're running a lot of temporal transportation risks if you're stuck in this traffic jam in the Gulf of Suez because you simply cannot go on. Yeah, I would propose to make a short coffee break, if that's okay for you.
Perfect.
Good.
Yes.
Yes,
Yes.
let's meet at 15:25, so 13 minutes roughly
Perfect.
before we move on. Great. So see you in a few minutes. Thanks. Break from the break. You can still hear me? Yes.
Yes.
Thank you.
Yes.
Thanks. Because when I stop sharing and start sharing again, it messes up everything at my screens. I don't know why. And I'm having always an issue. I prepare myself a coffee and then it's too hot to drink it. So sorry if I take a nap of coffee in between. Yeah, let's move on. Contract fulfillment risks. We have talked about this already. So basically, for the exporter, I'm thinking of us as exporters, as sellers, it's basically either the non-acceptance of goods, so the other party doesn't accept them, or the non-payment, or both in the end. And for the other side of the coin, so for the importer, for the buyer, if we as exporters wouldn't deliver, or if we deliver late, or if we deliver goods of poor quality, yeah, if we have received, or if the buyer has paid a deposit to the seller and he doesn't receive the goods, neither he receives the deposit back, etc. So everything basically you can think of between buying and selling. Again, how could you hedge against these? By contract design, by letters of credit and similar products, by guarantees, or by credit insurance. And we will talk about credit insurance in much more detail, but what I would like to show you when it comes to contract fulfillment risk is this map. Sorry, wrong screen. And this is a country risk assessment map. And I mean, as always, with such instruments, this country risk assessment map comes from a credit insurance company, from COFAS. It's at least one of the two biggest credit insurers in the world. So they have countries, they have offices almost worldwide, and they do country assessment based on the data from their insurance policies. And there may be at some points a little bit exaggerated, but the basic topic is true because they have a lot of information on payment risks, etc., in certain countries. And there are countries where companies pay very well, meaning they pay the amount they are asked for, and they pay on time as agreed in the contract. And you see, it's basically Northern America. It's most parts of Europe, not all of them, and you see it's Australia and maybe also Saudi Arabia and these countries. And the darker the red gets, the poorer the payment discipline is in countries. So as you would say, if you would buy shares, then you would say A level, so everything which is green color is investment grade. B is rather risky, and starting from C and going on to C, D, E, etc., you have a high risk, meaning a high probability of not getting paid on time and in the correct manner. So it doesn't mean that you are not getting paid at all, but it means that there may be some deliveries, etc. And what COFAS and a lot of other insurers, etc., do, they try to provide you with such risk assessment. So, I mean, Russia is complicated, but delivering to Algeria, you may think of any hedging options in securing your payment. And this may be credit insurance, or this may be a letter of credit we will learn about, etc. But everything that helps you secure your payments, you have to receive. And looking at the world map, you see from our perspective, we are not completely dark green, but I would say we are still at satisfactory levels or very good levels. In Austria, we are used that we are getting paid on time and in the correct way, etc. So from our point of view, most parts of the world are rather risky, and we should think about it. So this is what this map tries to say you. What they also do is they try to break it down to certain industries. and to certain countries. So here you have, let's say on the y-axis you have certain industries, and on the x-axis, as it would be in math, you have certain regions. So you see, agri and food business is a rather good business in most of the countries. Interestingly, you have a higher risk in Western Europe for whatever reason, and in the Middle East and Turkey. Automotive is riskier in all of the regions. Chemical is riskier in most of the regions, and pharmaceuticals usually pay on time all over the world. So if you're in the pharmaceuticals business, etc., then you're usually not encountering too many problems. And again, this is coming from an insurer. This may be a little bit exaggerated in the terms of how high these risks are, because of course, in the end, they want to sell an insurance to you, but still there is some truth in it. And also, if you look at things like construction industry, so in Austria, it is famous for the construction industry to not to pay at all or to go into insolvency proceedings. So in Austria, it's quite common for small construction companies. They set up a company, they do something, they do not pay their social security taxes, they get bankrupt. 2 days later, they set up a new company, and then it's the original founder's wife or brother or cousin or whoever sets up this company, and they go on again. So this is an industry very famous for things like that. But again, such publications, such data, etc., may help you assessing risks and considering what to do, especially if you do business for the first time abroad, or if you start to conquer new markets. For instance, you were in the paper business and you were only in Asia and South America and in Europe so far, and you would like to export to the Middle East, then you see from this publication it may be a bit riskier, and therefore I should think as an exporter of any risk hedging options when it comes to payment. Another type of risks are political risks. We see it increasingly at the moment or during the last years. So political risks in the stricter sense refer to loss or damage that occurs due to foreign political or domestic political developments. For instance, a war, a blockade, as you now have it in the Strait of Hormuz, a boycott, meaning like a trade ban. Somebody is banning your products from the market, but also in foreign countries as well as at home, strikes. So if you were on the way for a business trip, for an important one with Lufthansa today or yesterday, then you may have a problem. Unrests, civil wars going on, etc. So all these developments are being considered as a political risk. In addition, things like seizure or loss or damage of goods due to any political motivation. So seizure, I think everyone knows this, and Eignung. This happened a large scale, for instance, 30 years ago in Venezuela, when all the oil fields and refineries of American companies have been seized by the socialist government under Hugo Chavez. And that's potentially a reason why Mr. Trump is intervening there now. Similar things happened in Russia due to the Russia-Ukraine war. So a lot of companies withdraw from the Russian market more or less voluntarily, but you still have some Western companies in there. They have their subsidiaries, they earn money there, but they simply cannot get their money out of the country. Maybe some production lines have been seized, etc. So these things, unfortunately, happen at an increased frequency during the last years. Yeah, and also sudden trade policy measures such as non-tariff trade restrictions, etc., licenses, quotas. Think of Mr. Trump. Tariffs were banned now by the court, so he will employ any kind of non-tariff trade restrictions, introducing, I guess, quotas on steel, etc. So we will see what happens. In a bit of a broader sense, a political risk is also a payment ban or so-called moratorium risk. A payment ban usually means a complete payment ban when the debtor who is willing to pay, who is able to pay, he has enough funds, is prevented from fulfilling his payment obligation against you as a seller because of any measures imposed by the local government. So if the Russian government tells you, dear Russian company, you are not allowed to transfer US dollars or euros out of the country for whatever reason, then he may be solvent as your buyer may be solvent as possible. He may have enough money, etc. He's simply not allowed. For you, it still doesn't change the issue. You're running this political risk. If you cannot get your money for whatever the reason, you are not being paid simply. And a rather similar thing is a so-called moratorium risk. It's a temporary suspension of payment. Again, it's issued by the government of the certain country, and its payment abroad is not completely forbidden, but it's suspended maybe for 3 weeks, maybe for 3 months. This happens rather frequently, especially in countries who are very low on foreign payment reserves, foreign currency reserves, and to sometimes need to prioritize in where the payments are going to be made. So my typical example for Europe, because it happened like 4 times in 15 years, always used to be Ukraine. It was before the war. But in Ukraine, you had a payment moratorium like every 3, 4, or 5 years because they were running low on foreign currency reserves. And then they needed to prioritize, and usually they prioritized payment for energy delivery, so paying for oil and natural gas to Russia, basically. And as they needed foreign currency for that, they said, okay, our reserves are reserved for that. And all the other companies will receive foreign currency only if it is available, or they won't receive any for the next 2 months because we need everything to meet other payment obligations. So yeah, what can the Ukrainian company do if they are not able to buy US dollars or euros? They need simply to wait until this moratorium ends. Because again, we in Austria wouldn't have accepted Ukrainian hryvnias, because it would be impossible to have them exchanged for a freely convertible currency in Austria. So it wouldn't be of any use for us. Conversion and transfer risks. Conversion risk is the country completely prohibits to the exchange of their currency into another currency. They want to use their own currency. Again, it's a thing of currency reserves, etc. Or they want to control the exchange rate. So it's usually countries where the currency is not freely exchangeable in the world market. It's an issue in a lot of countries. You then need to think of certain countermeasures like offsetting. You're getting goods from the country instead of payment. You are doing barter trade, would be the technical term. It used to be very common, even in Europe during communist time, where you delivered, I don't know what is a typical example, Volkswagen delivered golf cars, Volkswagen Golfs to the German Democratic Republic, and they received machinery and steel and the planetarium for Wolfsburg in exchange. So you're doing barter trade, you're exchanging one good for another, basically. transfer risk, quite similar to this, you may be allowed to buy a foreign currency. The company abroad may be allowed to possess this currency, but it may be forbidden to transfer this currency abroad, because again, the country wants to keep the currency under control. There are hundreds of creative ways how to deal with it. So companies in these countries really become creative. Usually you would try to hedge it in a, let's say, more legal manner. So appropriate terms and conditions, all types of credit insurance, all types of payment methods like letters of credit, etc. Guarantees. We will see in detail what we can make when we talk about these instruments, but there are some ways to get around it. And sometimes, frankly speaking, it involves 3 or 4 countries, because then usually you don't have bans or transfer bans, etc., to all countries. So maybe money finds its way in the end. These things happen. And we talked a little bit about transaction risks. So transaction risks, basically from changing exchange rates. So if the exchange rate changes, it may mean a loss or a gain, depending on how it changes. Again, what could you do about it? Contract design. I always think, if possible, the natural hedge is the best option. So if you are producing something in your subsidiary in the United States, try to sell it to markets where you receive United States dollars. If you are producing something in Europe, try to receive euros, because then you don't need to think of any currency hedging methods. And the other options include all kinds of derivative products from banks, just to say some forward exchange deals, currency swaps, etc. I think we've maybe come across these topics already a little bit. But there are a lot of products on the financial market that can help you hedge currency risks. Economic currency risk is a bit, so let's say transaction risk is rather short term. Economic currency risks means something to the long-term competitive advantage of an economy. So a typical example where we have seen that over the last 20 years is Switzerland. Because the economy being really strong, the currency being really considered as a safe haven. So the Swiss franc appreciated quite a lot over the years against the euro. And some 20 years ago, you used to get 2 francs for a euro. Nowadays, it's basically 1-on-1. It's changing a little bit all the time, but this means something. So it is really appreciated, and then does something to the long-term competitiveness. And especially if you have foreign direct investments, or if you have very long-term delivery contracts or something, you need to take these things into consideration and try to analyze future cash flows thoroughly in order not to run into these economic risks. And besides a thorough analysis beforehand, things like local sourcing, local production, etc., are always a good idea. So try to do a natural hedge, basically. And we have briefly talked about the translation risk, the issue where the exchange rate does something with accounting evaluation, where it does something to a balance sheet and profit and loss account, which is basically a problem on paper at first sight. But of course, if your balance sheet and your profit and loss account change rather dramatically just due to currency changes, it can do something to your creditworthiness, to your standing with banks, etc. So also don't leave Don't leave this type of risk out if you find yourself in a company with a lot of foreign subsidiaries, with a lot of export business, with a lot of invoices where you sell on open invoice and you have receivables in your books, because always think that you need to evaluate these, and you're running into this translation, meaning basically valuation risk at the end of the day. Yeah. One thing I especially like, and why? Because it's overlooked all the time, is legal risk. I think it's the most underestimated risk you can have in foreign trade. The basic thing is, and this happens also in Austria, you don't need to go abroad, is buying and selling on your standardized general terms and conditions, die allgemeinen Geschäftsbedingungen. Who does buy and sell on the basis of the general terms and conditions? Do you have this on your invoices in your company? Dieser Vertrag unterliegt unseren allgemeinen Geschäftsbedingungen?
No.
No?
Er muss nicht, kann kongruent angenommen werden.
Ja.
Man muss es nur wahrnehmen. I don't know how it's called in English, to be honest.
Yeah, it's no problem. But
But
usually
it's not allowed something that is against the customer, I think. Also ich glaube, man darf ja nichts
Against the-
drinnen verstecken, das was
Ja, nicht für den Kunden
genau
unvorteilhaft.
irgendwie so.
grob nachteilig would be the law, but usually usually it's this isn't the case. But what happens is usually the buyer sends you an order or something and says, and I'm buying the goods according to my general terms and conditions. You are selling the goods, and your invoice says in the end, I'm selling the goods according to my general terms and conditions. And this may be an issue. This may be an issue if you're selling from Vienna to Innsbruck. Because if your buyer is in Innsbruck and he says, I'm buying to my general terms and conditions, then he will say, okay, in case of a dispute, my court is in Innsbruck. If you as a seller in Vienna and you're selling to your general terms and conditions, they will say your court of decision in case of any dispute is Handelsgericht Vienna. And the issue then is, if both just put this onto the order and on the invoice, what have you agreed on, basically? Any idea?
Nothing. No, it's
Yes.
always from the seller point, or?
No, not necessarily. And especially not in
B2C.
international trade. Yeah, B2C is easier because B2C you have
There's just one.
Konsumentenschutzgesetz,
Yes.
and then it's the buyers. So if you buy something private, court of decision is always the one where you live. But B2B, you can agree on anything, and in most of the cases you don't agree on nothing. You agree on nothing, sorry. Which is not much of a problem in Austria, as it is still the same law, it is still the same court proceedings, etc. But it can become a problem. It can become a problem if it is somewhere abroad. And a lot of things that look similar may not be similar in other jurisdictions. And also these things happen that you don't agree on anything. And then you may export as an Austrian company, and it may be obvious or acceptable that saying, my law says it's the country and the court of my jurisdiction, I'm in Austria. And the buyer's country's law say, okay, but it's obvious that the court of jurisdiction and the law applied is the one of the buyer's country, and it's maybe Turkey, for instance. And then you have not agreed on anything, and then you try to find out at a later stage which country, which court, and which legal system is to be used. And then you might find yourself in front of a Turkish court, or your Turkish business partner may find himself in front of an Austrian court in case of a dispute. And the worst thing ever is, no, the next to worst thing is if an Austrian court has to apply Turkish law or the other way around. Also, this happens. And the worst thing that may happen, and it's not that rare, is that both courts in both countries say, I'm not responsible, it's the other side. And then you reach no decision at all, because simply both countries, both courts refuse to do anything about it. And then you are completely stuck, basically. And this happens quite a lot. So there are huge books about this. If you would be interested, it's Konfliktnormen in German, so conflict laws, basically trying to solve things like if something happens during transport or whatever, which country, which jurisdiction is responsible to deal with what. So this is something lawyers can discuss for years. The better option, if you think of buying or selling someone, is to agree upfront on something. So either you agree, if you're selling to Turkey, that Austrian law applies in front of an Austrian court, or Turkish law applies before a Turkish court, but at least it is clear. And if you don't want to grant, or if both parties don't want to grant one party the advantage, the hedging option would be to agree on some kind of international arbitration law. Arbitration law, don't know whether you're familiar with the term Schiedsgerichtsbarkeit. So it's basically not necessarily country-specific law, but it may be due to some international agreements, due to terms and conditions, etc. You agree on an arbitrary court, and on an international basis, very famous, at least from a European perspective. You have an International Chamber of Commerce, headquartered in Paris in France, and they have an international arbitration court there, so you could always agree on having disputes solved before that court. Of course, when we're talking about such options, please think large scale. This makes sense if you have contracts of some hundred thousands or maybe billion euros. It doesn't make sense if you have a contract for 5,000 euros, because then these arbitrary proceedings are way too expensive. But if it's bigger amount, it really pays off to think of these options. And just very, very briefly, you don't need to remember, but legal systems you may find around the world. You have the Anglo-American system, which is basically used in half of the countries in the world. So think of former British colonies, think of countries inspired by Great Britain, Canada, United States, etc. Maybe the most important financial and stock exchange centers are in these types of jurisdictions. So London, Singapore, etc. New York, they all have this type of law. And basically it's what you usually see in these American television things. So it's a lot of case law, where then a ruling from 1847 is cited because the judge decided something, and that's why we need to decide as well. We have a French legal system, the so-called Napoleon law, which is used in many EU Western countries, everywhere basically where France was, and in a lot of French colonies in Africa, Asia, and partially Latin America. And then, Code Napoleon or Code Civil and Code Commercial is the basic foundations of our law as well, but we have some kind of a mixture, because there was a German legal system, or is a German legal system, coming from the German Empire of the late 19th, early 20th century, where a new codification based on this Napoleon law was done. And interestingly, a lot of countries in Europe, especially Eastern Europe, but also Russia, and interestingly, Japan and China overtook a lot of these things. Maybe they abolished some of them at a later stage, for instance, China. But you find in a lot of Eastern European countries and also in Japan laws that look very similar to the things we are used to. Yeah, and maybe a good remark, be careful even within the European Union. We all know there's something like an European business law, Europäisches Wirtschaftsrecht. You can even study that. However, this means something about competition rules, about non-discrimination, about the four freedoms and all these things you have learned about. However, it's not commercial law. So commercial law always remains country specific, and therefore even selling goods within the EU is always foreign trade, because the legal system may be different, and the difference starts when you start to deliver to Germany, although we have the same language and a lot of shared history. Even the basics look different. So from a banker's perspective, and a hypothek in Austria is something different than a Grundschuld in Germany, and it needs to be treated differently. So don't need to remember all these different types of laws or legal systems, but just to have a little bit of awareness that these things may happen, and it may be an issue. And please always think to agree on something at least. Yeah, other risks, adverse business risks. Sounds a little bit technical. Basically, all business practices of some kind of a negative nature, or facilitation of business or payments. Basically, it's bribery and it's money laundering. Bribery, you know what bribery is? To bribe someone, corruption, basically. Money laundering means the intention is to disguise the origin of funds. So money laundering, usually you try to launder money coming out of some criminal activity. Famous
Is it something
examples
like
are,
Geldwäsche?
yes, money
Okay,
laundering
yeah,
is
okay.
Geldwäsche. Yes, and bribery is Bestechung, Korruption. So both. Bribery is Bestechung in the sense of you bribe somebody, or Bestechlichkeit in the sense of you are accepting bribes. Thanks for asking, so we can clarify. Yes, money laundering, famous examples are the Italian mafia laundering money through huge investments into the real estate sector, into the infrastructure sector. So they are building apartment buildings, office buildings, they are building bridges, toll bridges, etc. So you try to disguise the origin of funds coming from criminal activities. Warning signals. If you ever try to set up an account with an Austrian, German, or any European bank, and let's say any bank in a developed country, you will need to undergo so-called KYC, know your customer procedures, meaning basically a compliance and an anti-money laundering check. So you will have to prove, first of all, who are the owners, the beneficial owners of your business, and secondly, where do the funds come from? And yeah, all kind of warning signals may come from unusual settlements, unusual transfers, instructions, all kind of secrecy, rapid movements of money. So if you have if money is moving around between 15 companies in circles, it usually means something. But this is more something to be considered by banks or by criminal investigators, basically. Still, if you would find yourself in buying something and then you get the payment instruction in your contract that you need to pay to a completely different company, you should ask yourself why this is necessary. Why are you not paying to the seller? Why are you paying to somebody else? Maybe they want to have a different reference in the payment than what the contract refers to. All these things should be warning signals for you if you do international business, because you don't want to find yourself in money laundering proceedings. Not voluntarily, because then it would be a criminal activity, but also involuntarily, you don't want to find yourself being investigated by the criminal police of any country. And in most of the countries, they are not as friendly as in Austria or Europe. So if you would ever be arrested somewhere abroad because of the suspicion of money laundering, then yeah, you may be in real trouble. What does bribes, money laundering, etc. do? They distort trade patterns, of course. They are strongly counterproductive, as it says here. Usually it means something for direct investments. So you would think twice or 5 times to invest in a country that's famous for being very corrupt or laundering money, etc. Yeah, under most jurisdictions, money laundering is illegal. And the thing is, companies bear full responsibility in under European law. Even the company's representatives bear full responsibility. So what may happen is that you, as a CEO of a company, may be punished, meaning you have to pay a fine out of your own pocket, and the company is not allowed to compensate you for that. So yes. That's why usually in every bigger company, corporate structure, you find somebody called a compliance officer who is taking care of these issues and try to make sure that everything is compliant according to the law, etc. And where you could turn to if you have any question. And there is a former quote from a famous quote from a former U.S. Deputy Attorney General, as a Generalstaatsanwalt, saying, if you think compliance is expensive, try non-compliance, meaning if you say from the compliance officer and you find yourself being non-compliant, then you are really heavily punished, meaning you pay a lot of fines. Usually it's a certain percentage of your turnover, which can do a lot of harm to your company. Yeah. Again, a small map. I don't know whether any one of you knows this corruptions perceptions index. Did any one of you came across this already? No, obviously not. So the corruption perceptions index, something I find to be very interesting, is done by Transparency International. It's basically an NGO. And they have offices in a lot of countries of the world, so they do a lot of publications. And this index is based on surveys. So what they basically do is that they ask, of course, anonymously, business people from countries, lawyers from countries, politicians, etc., basically on how corrupt do you perceive your country. And yeah, if you look at this map, then the lighter the yellow gets, the less corrupt the countries are. And the darker the red gets, the higher corruption or perceived corruption you see in these countries. And what you see traditionally is that Scandinavian countries are considered to be rather clean countries, very little corruption. I mean, they are also considered to be very open countries, very developed countries, etc. So it's they're usually among the top 10. You see Central and Western Europe of being rather clean. If you go to the south and to the east, you see that corruption or the perceived corruption is increasing. You see Northern America and Australia and Japan to be rather clean countries. And you see countries like Venezuela in dark red. You see countries like, what is it, Libya in dark red, etc. So yeah, everything below a score of, I would say, 50 is getting complicated. But again, as with the risks, and you see there is connection between these things we are looking at. As with the risk section, there's a truth in it, and you see that at least 3/4 of the countries in the world have a corruption problem, at least, again, from our point of view. If you live in Libya, you may see differently because it's the normal course of business for you. From a European or, let's say, Western perspective, it's an issue if you have to bribe somebody. Yeah, one example, Mrs. Cayley, I don't know who remembers her. It's like 2 years ago from the European Parliament. She was the one to accept bribes from Qatar. Second example, Mr. Trump made it perfectly legal to bribe abroad. I think we have discussed it the last time. Am I right? That said it was legal even in Europe like 25 years ago to bribe abroad. So if you bribed somebody, let's say in Saudi Arabia to buy your goods, then you could deduct it from taxes in Austria or in Germany. This was abolished under our laws now. It was the same in America. And Mr. Trump made it more or less legal again to bribe abroad. And I especially like his smile on this picture because I think it says everything. Yeah, I've put some links in there if you would like to look at these maps up. Europe in a bigger picture, so you can see the country scores. So as Austria, we are at a score of 69. We have improved a little bit over the last years. And at the bottom of this slide, you see the situation in Austria and the changes in position. So lately, from 2024 to 2025, we have reached a better rank. So we were worse already. If you remember, it was all this issue about Sebastian Kurz and his friends, etc. So the perceived corruption during this time was higher. And let's take corruption in a broader sense. So also nepotism, Freundalwirtschaft, as we would say in Austria, is an issue in these statistics. But again, being a foreign direct investor and looking at a world map and needing to decide where to set up a company or not, I myself would choose a region where the corruption is not that high, because it may help my business. Or I may be choosing a region where corruption is high and local government is very weak and police is non-existent. For instance, if I'm an illegal weapons trader, no, very bad example, but you know what I mean. There are some industries, to put it like that, maybe engaged in criminal activities, who prefer certain countries. So if you look, for instance, where Myanmar is, and you see it's rather darkish in the red, all these scam industries you see nowadays trying to steal money from you through internet scams, they have huge industries, for instance, in Myanmar. So there was nothing like 10 years ago, and now you have huge data centers where people are treated like slaves and they need to work 12 hours a day just to scam you all the time. So it may attract certain activities as well. Yeah. Summary for the risk management. This is coming from your textbook. So to sum from the textbook I recommended, not your textbook because you don't need to read it, but to sum up very briefly, risk analysis, what risk, what magnitude could be assessed for this transaction or for this business. what can be covered through terms of payment in combination with guarantees, with export credit insurance, with all the methods we are going to learn. Will the other party accept them or not? And then you have something you would call a residual risk. So some risks you can't get rid of, basically. And are these risks, the remaining risks, acceptable for you? And then you need to decide, basically. If you find them to be acceptable, go on in your negotiations, prepare the contracts, make the business, and you will find yourself happy. If not, think of alternatives. Either you need to rethink the business with this counterparty, or you say, okay, I'll leave it. I'm not doing business with them. It's too risky for me because the partner doesn't seem to be all right, or the country doesn't seem to be all right, or the political and legal situation is difficult. Then it's better to leave. Another professor of mine said, you don't need to do every business at every price. So I think this is not the worst advice in the end. Before finishing off with this risk section, any questions to any of the topics, to certain risks, to risk analysis management? Anything unclear?
No.
Not at the
Everything
moment.
unclear?
No.
Yes.
Who said yes? You're getting a private lesson. No. Are we ready to move on to terms of delivery, or do you need a short break again?
A short break.
A short break? Okay, then let's
Yes.
let's meet at 25 again, if that's okay. 13 minutes.
Yes.
Perfect.
Perfect. Thank you.
Bye.
Welcome back again for the last time for today. Oh, one thing I would like to do for today, and then I think it's enough for today also, is a few slides on the terms of delivery. May I just ask who of you has been to a Handelsakademie before the studies? Are there any among you? Yes.
Yes.
Quite some usually in business studies. So you may find these things familiar. So sorry for bothering you and boring you maybe. But I'm pretty sure you have learned about these things before. Talking about terms of delivery, very unsurprisingly for you, we are usually talking about Incoterms. And I guess all of you, at least those who have been to the Hack, have heard about Incoterms before. Because you usually learn it in business administration, that there are some things like that. You learn it in your English conversation that you have Incoterms. So yes. What do Incoterms regulate, or what have they been invented for, is basically it's standardized terms of delivery. When and where this or which determine when risk and obligations passes on from the seller to the buyer. And the basic idea is that you don't need to agree separately on everything when designing your sales contract, but you use a standardized term which have one of these standardized Incoterms which have become the standard for world trade basically over the last 30-40 years, and which have been revised and updated several times since then. But they are still very widely used because they have proved to be very efficient and very simple and quite easy to understand, and the fulfillment of obligations is clear and obvious, so you don't need to discuss. So as we said, mostly it deals with the transfer of risks and with the transfer of obligation, and in these connections, obligations usually means the obligation to pay. So on one hand, to pay for the goods, but also to pay for the transport and to pay for customs, duties, taxes, whatever comes to your mind with the export or import of goods. The Incoterms, they are even a registered trademark, interestingly. They are not prescribed by law anywhere, but they have been developed, let's say, out of business practice over the years because they were found to be suitable for doing business. And they are standardized by the aforementioned International Chamber of Commerce headquartered in Paris, who have somehow written down these rules for international trade for the terms of delivery. And they are used basically all over the world. If you're using Incoterms, you sometimes need to look or should be aware of the version. So as we said, these are being updated like every 5 or 10 or 15 years, depending on the necessity, basically, and on what changes. So the latest version of Incoterms out there has been updated in 2020. However, you should clarify it. Usually, if the contract doesn't say anything, then usually it's the latest version that's going to be used. If you would find a version saying it's the Incoterms from 1998, then please talk to your business partner and say, is that I mean, maybe out there, is that a mistake, or is that an old template you're using, or is there a certain reason why you're doing this? Because the definition of the terms may change slightly, and maybe he sees an advantage you don't see. But again, this is something that should catch your attention, and you should be aware that, okay, this is not the latest version, and discuss why. Most of the times it's simply an old template used and nobody has updated it within the company. Yeah, as we said, recognized throughout the world. And we said, what do they specify and how do they specify it? They specify the obligations. So who does what between the seller and the buyer? Who does what in sense of who organizes the transport, who organizes the carriage, who organizes transport insurance for the goods, who obtains the shipping documents, export, import licenses, etc. You have the passing of the risk. So when and where the seller delivers the goods basically means where the risk transfers from the seller to the buyer. I guess you had lessons in private law during your studies, and the passing on of the risks was a topic there. So you have in private life, you have these basic examples. When does the risk passes on when you buy a car, you know? Anyone knows if you buy a car when the risk passes from the seller to you?
When you receive the car and when you get the car.
Yes, so basically it's usually the physical handover.
Yes.
With a car, as it's a bit difficult to hand it over physically, you say it's usually symbolic by handing over the car keys. Meaning, if you receive the car keys and you're getting handed over the car, and you ask the seller whether you can still leave it over the weekend there because you don't have time to have it registered on Friday. You want to do it on Monday, and a thunderstorm comes or a hailstorm hits your car, and it's completely damaged outside on the parking lot. Then it's your damage already because you have already received the car. So it's not necessary to register it. You could buy a car and put it into your private museum because you like to look at it. You don't need to register it, for instance. Another example, private law. Usually, I mean, yeah, it's not a very clear example, but if you're buying a house, then usually it's said you become the owner and the risks are passed on as soon as you are in the land book. A house is not the best example because you can be what is called an außerbücherlicher Eigentümer in Austria. There it would be more difficult. Bad example, sorry for that. But you know what I mean, when all the rights and obligations pass on. And the same is true for the costs. And costs connected to a delivery usually mean something like the costs of transportation, the cost for insurance, the costs of paying duties, taxes, etc. And if you see all these risks, obligations, etc., if you would need to negotiate all of these things in every contract from the very beginning, it's rather costly and it's rather time inefficient because it takes you a lot of time. So it's a good idea to have standardized terms for this. And you have basically two sets of terms, or usually you see them only as one, but you have terms of delivery that apply for any modes of transport. So it doesn't matter whether it's road transport, whether it's marine transport or inland navigation, or whether it's air transport or train or whatever you can think of. And you have specialized terms of delivery, specialized Incoterms, which are used only for shipping goods either on the sea or on rivers. So inland navigation usually means rivers. So used only if you transport goods on ships, and usually they have they sometimes have things like free alongside ship or free on board, so you can think of the ship even from the name of the term. And all or most of these can be used for any modes of transport. And let's look at it in a detail. I once found this chart from basically a trading house, and I like it very much because it's very transparent in one picture what these terms do cover and where all the risks passes on. So think of us as sellers, as exporters, as we're talking about export business. Everything that's in dark blue means it's our obligation. We need to take care of it as sellers. And everything that's in this reddish salmon color, at least on my screen, means it's the buyer's obligation. So the buyer needs to take care of these things. And then you have this exclamation mark, and this exclamation mark means the transfer of risk. And the first thing you see is that sometimes the transfer of risks happens where the obligation moves from the buyer to the seller, and sometimes not. So this is the first thing you need to be a little aware of, that the transfer of risk may not always be at the point where the obligation, meaning basically the costs, transfer from the buyer of the sellers, but you have certain clauses where it is treated differently. And talking about exclamation marks, I would put a big exclamation mark to this slide as for the final test, which is the bad news because there's a lot of Incoterms. So let's try to make it a little bit better news, and I want you to know 4 of them. Why 4 of them? Because the idea is 2 extremes, so the extreme levels, and 2 in between, which are usually very widely used in international trade. So there may be good reasons for all of these clauses, no matter which one of them. But the 2 in the middle, free on board and cost insurance freight, I think the most widely used terms. They are some statistics from the ICC, which terms are used the most. They do surveys on this, and those are really among the most used ones. But let's start with the simplest thing from our side, from our position. If we are sellers, if we are exporters, the most simple thing is X works. Who pays for the transport with X works?
The buyer.
Yes. So we see also the passing on of obligations from dark blue to this orange, and the passing on of risks happens basically at the gates of our factory. So until the thing is loaded on the truck, everything is our obligation. As soon as it's loaded on the truck, it's the buyer's obligation. So the buyer needs to pay for needs to organize for the carrier, for the freight forwarder. He needs to pay for the freight. If he changes the mode of transport, he needs to organize for the unloading and reloading again. He needs to take care of all the import licenses, of all the customs clearings, etc. Basically, everything is the buyer's obligation. And also the transfer of risks. As soon as these things are loaded on the truck or leave our factory, basically, everything is the buyer's risk. We as sellers don't care anymore. Perfect situation for us. But it's the same as with payment in advance, etc. It may be hard to get in international trade, depending on your bargaining power. If you're the only person that produces something because it's very specialized, etc., you may get any conditions and ask for any price, but this happens rather rarely. The other extreme is the DDP clause. DDP, you see, it's always an abbreviation, so it's delivered duty paid, which means that we as sellers have to take care basically of everything. We have to take care of which freight forwarder do we choose, which transportation routes, which modes of transportation. We have to pay for the transport. We have to pay for an insurance. We have to pay, as it says, delivered duty paid. We have to pay all taxes, all customs duties, etc. So really the buyer gets it delivered to his place at a defined cost. Yes, Julius?
Is it necessary that in the DDP that only the seller pays the insurance, or is it common that it's split between the seller and the buyer? For instance, just the insurance.
Usually, as you see this transfer of risk, this exclamation mark, this basically means that you are, as a
Okay.
seller, are obliged to
Really?
bear all the risks until the place of delivery.
Okay.
So it is advisable for you, it is advisable for you that you take care of a good insurance. Otherwise, if something happens, you have to bear the costs. So the idea of these clauses is to have it very clear.
Okay, yeah.
But it's like 3/4 true. We will see. I will tell you a different story when we come to the SIF clause. There's a bit more to it as well. But
So
under DDP,
all
sorry.
costs are really by the seller. Till
Yes.
this moment. Okay, okay, yeah.
So the exclamation mark is important because transfer of risks always means if something happens to the goods, who carries the responsibility? And as seller under DDP, we have the responsibility really until the place, until the final destination at the buyer's place. So it's in our interest to have these things insured very well. In opposite with Ex Works, it's in the buyer's interest to have the goods insured very well, because if they break or if they get perished or whatever happens on transport, it's his risk. So in these extremes, it's very, very clear. Another thing is free on board. Let's look at Ex Works and DDP. Clear so far? Or any questions? Okay. So free on board is rather straightforward as well. We have seen that this is a clause which is used for marine transportation or either on international waters or inland navigation on rivers. You use free on board and you use the SIF clause. Free on board simply means really on board of the ship. And if there are more than one ships involved, so if you need to reload at some point in time, it's the first ship on the transportation route. So talking about us producing something and selling it, we would need to take care of the first carrier, the truck company, whatever. And we would also need to take care of the loading until the goods are loaded to the ship. So really think of it physically. In a container harbor, we pay until the container is loaded on the ship. And also the transfer of risks happens at the moment when the container is loaded properly on the ship. So just to ask this question, what happens if the crane driver is drunk and he drops the container because he hits the wrong button and the container falls down from the crane either onto the port or into the water and the goods are damaged? Whose problem is it under free on board?
The one of the buyer?
Is it free on board? Was the container on board already?
No, then it's the seller.
Yes, then it's our problem. And that's why we should also take care of insurance. I mean, if the crane driver is drunk and he drops it, then the crane company or the harbor company needs to compensate for that, of course. But in case there is a traffic accident on the way to the port, we should take care of transport insurance because we still have the risk with us. And this is something you find in the legal textbooks, etc. It's a typical example. What if it drops from the crane into the water? You could then ask what happens if the container falls on the ship. Maybe it's still not properly stored and loaded. So it should arrive on the ship safely. Let's put it like that. So again, free on board means we pay everything until here. It would be advisable to have it insured, and we need to pay for the insurance until here. Of course, is our risk assessment whether we want to have transport insurance or not, or whether we risk it or not. But usually it will be advisable if we have some kind of insurance. As soon as it has arrived at the ship, denominated by the buyer, so the buyer needs to tell us on which ship we should load the goods. But as soon as it has arrived on the correct ship, everything else is the buyer's obligation. So the buyer needs to, from here, the buyer needs to pay for the transport, he needs to pay for the insurance, he needs to take care of all the customs things, etc. He needs to pay all the import duties if there are any. United States now, a lot of import duties, etc. So yeah, it's his obligation. I think this is still rather straightforward, or not? Anyone confused completely already? Then I explain again, but I think it's quite okay. And to make it, sorry, I put these rings in here. I hope you have these rings in your presentation as well, but I'm rather sure that they are printed in there.
So these are the important ones.
Yes. So
Okay,
please
yeah.
put an exclamation
Yes.
mark, but only learn these four.
Yes. These are the common ones, or
yes. So the extremes, XWorks and DDP
yeah.
are not the most common ones, but they are good to start explaining the basic idea, I think. And free on board and safe are other common ones in large scale international trade. So really think of moving a lot of goods around on an international basis, maybe not only Austria to Germany. Yeah, Rhein-Main-Donau-Canal could be a possibility, but in international business, moving around ships, etc., then these are very common. And of course, on an international basis, container transport is still the most widely used mode of transportation if you really do large-scale international business. I cannot promise that you get one for your final tests, but there are questions for each of these four clauses with a ring around them. So maybe you may get one. If you get one, it's one out of these four. I say maybe you get one. Why? Because I've written like 150 questions and you are getting like 25 in this final test. And it's always done that Moodle chooses randomly. So like for every chapter, I have like 10 questions on risk management, etc. So, and 3 are chosen for the test, just to give you an idea how it looks like in the end. Cost, insurance, and freight is a bit of a special clause. Why? Because you see that the payment obligations and the transfer of risks fall apart. And still, it's very widely used, but I think it needs a little bit more of explanation. So basically, the obligation in the sense of who takes care of the administration and who pays the cost, I think is rather obvious. So the blue one, we as sellers have to take care of the costs until the port of destination, and we have to take care of all the administration which can mean like export licenses if available, like certificates of origins if needed, like taking care that the bill of lading has been properly issued. We will be talking about things like a bill of lading, etc., when we come to the payment methods in a bit more detail. I don't know whether you are familiar with the term bill of lading and Frachtbrief. You came across already? Yes, at least some of you. No worries, we are going to discuss it a little bit. Yes, Laura?
Sorry, I just wanted to say that I already worked with it.
Okay, perfect. Will this explanation work for me, or you will help me?
No, keep going.
We do that next time. No worries. No, but meaning we need to take care of the bureaucracy basically, and we need to take care of the costs until the port of destination. You don't need to remember it, but just as an additional information, taking care of costs until the port of destination includes until the ship arrives at the port of destination. It does not include the unloading anymore. So if you see this crane here in the destination port, this means under CIF clause, the buyer needs to pay for the unloading already. So it really means goods on the ship arrive in the port, but we are not responsible for taking the goods off the ship anymore. So you see, if you would take a deep dive into these clauses, they are very detailed in the end. From the port of destination, again, it's the buyer's obligation to take care of everything. This means he needs to pay for the unloading, he needs to organize for the next transport to his premises, he needs to pay import duties, taxes, etc. So again, this is his obligation. So at first sight, it's very similar to free on board. It's just not the loading port, but it's the unloading port, basically. But what the difference is, and you see it's kind of a combination, we pay the cost and freight and etc. Until the port of destination, but the transfer of risk happens at the loading port. So it happens at an earlier stage. And this is something you basically need to learn by heart to know it. You could not read it out of the name when the transfer of risk happens. But you need to simply to know it that CIF clause says transfer of risks happens at the loading port, again after the goods are loaded to the ship, the same as on free on board. Until the loading on the ship, we bear the responsibility for having the goods loaded and delivered there. So far, everything understood? Yeah, so we pay costs until destination port and take care of the bureaucracy. Buyer takes care from the destination port, but the transfer of risks happens at an earlier stage at the loading port. And if you understood until now, so let's make things complicated. No. Don't be afraid, but I'm not sure now. Was it Julius? Were you asking because of the insurance beforehand?
Yes.
Yes. So to make things a bit more complicated, we said that the transfer of risks happens at the loading port, but the clause says the name of the clause is cost, insurance, and freight. And what makes it a bit special is that this clause tells you as the seller, or us as the seller, that we need to pay costs until the destination port. The risk transfer happens at the loading port, but we are obliged under this clause to pay for a transport insurance. So this clause clearly states the seller pays for transport insurance. It's defined in this clause because for whatever reason it proved to be effective in international trade. So all these things come out of trade practices. Nobody was sitting in an office and thinking, oh, how can we make things complicated? But from general practice, it's developed that such a clause like this may prove to be efficient. So we basically pay for transport insurance until here as well, although we are not bearing the risk anymore. So this is maybe
But
what you had
you're-
in mind, Julius, with sharing the costs
Yes.
for insurance. So this is standardized basically in this clause. And that's why it's called cost insurance and freight, because you basically pay the freight costs until port of destination and you pay the insurance, although the risk passes on at an early stage. Confused?
No.
Do me the favor, let me confuse you a little bit on a Friday afternoon. I'm glad if it's clear and if you can follow. Referring to your question, Julius, and making things a bit more complicated, but you don't need to remember it. I tell it right away. You will never ask anything again. I'm sorry. No.
Come on.
Please feel free to ask and interrupt at any time.
Yeah. Thank you very much.
Now, extra information, you don't need to remember it for any test, but you will for sure if I tell you now. Cost insurance and freight SIF clause means we as sellers have to pay for the insurance. If you look deeper into the clause, you would find out that it's only minimum sea freight insurance we need to pay, really against basic risks like sinking of the ship, etc. My advice would be either you specify the clause and you say you want to have a higher coverage, eine höhere Sicherungsdeckungsleistung. So usually in transport insurance, in let's say under English jurisdiction or English terms which are widely used, you have three types of clauses. You have A, B, C clause, and let's think of A being very basic, only the biggest hazards are covered, and C is the full coverage. So I would specify and say, okay, it's SIF and C clause. So I want to have covered all of the risks under the insurance, or if you don't manage in the contract, and that's where I come back to your question, Julius, I would pay the upgrade as a buyer in this case. So if you forget to agree, etc., then I would say, okay, basic risks are covered under SIF clause because the seller pays for the basic insurance, and I would connect to my insurance company and say, I have a basic insurance under SIF clause from the seller side. What does an upgrade cost if I'm afraid that something happens to my goods? Maybe just to give you an example, if you have a thunderstorm and the container falls off the ship and it falls into the sea, this would be covered under the basic clauses. However, if the water comes on board of the ship doesn't sink, nothing, but the water gets into the container and your goods are damaged, this wouldn't be covered under basic clauses. You don't need to remember all these things, but just to give you a very basic example, I had lectures on freight insurance in maritime shipping as well, so there would be a lot of examples just to give you a feeling what can happen. So ship falling off the container falling off the ship would be covered. Water coming into the container on the ship would not be covered, and yeah, there it starts to get complicated, and maybe that's where it could be a good idea to have some additional insurance. But again, you don't need to remember it. What you need to remember is X-Works, DDP, free on board, and SIF clause. And please remember the specialty that under SIF clause, the transfer of risks from the seller to the buyer happens at an earlier stage. And that's all you need to know. So the question may be, where does the transfer of risk happen under SIF clause, and is it at the buyer's factory, at the port of loading, at the port of destination, or at the final destination? And then you need to tick the right box, just to give you an idea. Should be doable, I think. What can be deciding factors for you as an exporter? We always think as exporters, as we want to sell our goods as Austrian. So we should always think of the mode of transport, of the transportation route, the buyer, and the nature of the goods. So let's jump back quickly here. What is meant by the transport route, etc. We said using free on board clause, the buyer tells us the ship we need to load the goods. So the buyer chooses the ship, the transport route, etc. If we, for instance, need to deliver perishable goods, etc., we maybe don't want to choose the buyer, the port of loading, and the ship, because he may choose an unfavorable port, and let's say a less well-established transport company, etc. And we may run the risk that although we would like to deliver on time, etc., the transport routes are rather long, etc. We are running the risk of spoilage of our goods for whatever reason. So if we are afraid of these things, it may be advisable if we are the ones who choose the ship, and if we are the ones who choose the loading port and the destination port, because maybe we don't want to have our things reloaded for 7 times, because with every reloading something can happen. And if we are afraid of these things, then we may find ourselves in choosing one of the later clauses and saying we choose either SIF clause until the port of destination, and then we say we don't care anymore, or we choose one of the D clauses and say we deliver to your place, because then and only then we have full control about the transportation route, etc., and we can make sure that everything runs smoothly. So this is something that develops out of the nature of your business. And another extreme example, if you would be selling toilet paper that cannot perish, usually nothing happens. If it falls down with the container, you can still use it. So what may happen, we don't need to care. If these things are sensible in whatever way, I would prefer as a seller to have control over the transportation route. This is basically what it means here. Standard practices in the buyer's country, if there are any, and or official regulations in that country. So you have countries in the world that prescribe you delivery methods and payment methods by law. So for instance, I don't know, I think they abolished it 2 or 3 years ago, but for like 30 years, Algeria, Northern Africa, they said we want to have certain Incoterms only for deliveries to our country, and they allowed only payments to be made by letter of credit, because they wanted to have exercise control over the flow of money in their banking system. And they wanted to exercise control on all the duties, taxes, etc., to being properly paid. And if you prescribe an Incoterm and if you prescribe the payment method, you can rather simply exercise control on these things. Of course, it makes business more complicated and more bureaucratic. But for them, the government said, okay, we accept more bureaucracy. But we prevent any illegal practices or whatever. But these things happen. Always a good example, I have tried to avoid terms of delivery which are depending on obtaining import licenses, clearance of goods, etc. If you do not have experience in the buyer's country, or if the buyer's country is rather complicated, or if the buyer's country is highly corrupt. If you remember this Transparency International map, I like to see you smiling, Rahel, but these things happen. Yes, so if you deliver to Algeria to stay there, let's say I deliver everything until the port of loading, so E clause, F clause is perfectly acceptable for me, but I don't have connections to Algeria. I don't know the authorities in Algeria. I don't know the legal procedures. And Transparency International tells me it's deep in the red as regards corruption. And I don't want to get involved in corrupt practices. Then please choose a clause where all these obligations are the buyer's obligations and he shall take care. And he will be very familiar with it. He won't have any problem with corruption because he says it's not corruption, it's the way we do business here. By the way, another method usually is if you do that on a frequent basis and you don't want the buyer to do it, then you have a local agent and he gets a consulting fee, and whatever he does with the consulting fee, you don't know and you don't care. Basically, now it sounds rather weird, but it's the way the cookie crumbles, as the British would say, because you need somebody who is familiar with the practices in those countries. But the advice is you don't want to be responsible for anything you cannot easily manage from home. And dealing with bureaucrats in such countries usually requires good connections and good nerves. Yeah, of course, depends on your competitive situation, basically on your negotiation power. So if you are the only one who produces Starlink satellites and somebody wants to have Starlink internet because they don't have a local coverage, then you can demand almost any price and any terms of delivery. If you are producing plastic bottles and there are 3,782 other producers around the world, then you may not have any competitive advantage in negotiating. Yeah. Of course, the knowledge of your business partner, a trading history you have, if you have delivered 78 times on SIF clause, why shouldn't you do it on the 79th and 80th contract if all worked well? If you don't know each other, every party will try to choose the option that provides the most security. So you will find yourself somewhere in the middle, usually. You need to draw this at the final test. No, I'm kidding. And I don't know whether you can read it now when I share it like that, but I have uploaded these flowcharts into the section for interested one in Moodle. So if you would like to have it, if you come across these things in practice during your work, this is basically a decision tree, and it helps you to decide which clause can be suitable for your business. And you would start, so this is the seller's point of view, the importer. So you would start here like, are you ready to bear all the costs and risks until the goods arrive in the destination country? And you say, okay, yes, I'm ready. Can you obtain the required import licenses and carry out the import formalities? Can you recover the import VAT? Think of Algeria, maybe no. So we choose no, we cannot take care, or we don't want to take care. And then third question, can you unload the goods from the arriving transport in the destination country? Let's say, maybe they are on strike, we don't know. So let's say no, we want the buyer to organize for this. And then you end up with DAP clause delivered at port, and we are done. And this means import licenses, VAT, unloading of the goods, etc. All of these things the buyer needs to take care, which would be advisable in a country like Algeria, for instance. So basically, you can use this as a help for deciding which clause would be suitable for you. if you are the exporter. And there's a second flow chart if you would be the importer, if you are on the other side. Then again, with a few questions, it helps you to find out the correct clause. The problems start when both parties find a different clause. Then you may start to negotiate something in between. And again, this chart where I put the exclamation mark before may help you to analyze the spectrum. So for those who may need this in your practical work, you find it on Moodle. But don't be afraid, you don't need to draw any decision trees in the final test. I just wanted to check which one of you is still awake and whether somebody gets a heart attack now or not. Yeah, and my proposal would be to continue with terms of payment when we meet next time. No, not next time, because next time is, I think, the 20th. It's next Friday. I would like to finalize the project finance section there. So the next time would be April. So you have a huge break then. Thank you. Have a nice evening, have a nice weekend, and
You
looking
too.
forward to seeing you real soon in real life again.